to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Actually, I can't hear anything, but welcome to the show. I'm going to be waiting for a little bit. While I'm waiting, I think I'll just talk a little bit about the upcoming seminar. We've got a seminar coming up pretty quickly, and we're going to be talking about the highest rate of return that you can get on safe investments. There's no cost to attend this seminar. However, the seating is limited. That seminar is going to be Thursday, September 20th, and it's at 6:30, and it'll go to 8:30. Actually, I'll probably let you out a little bit earlier on that, but we're going to be talking about the highest rate of return you can get on safe, quote-unquote, investments. Things like CDs, government bonds, why some stocks can be considered safer than others. We'll talk about how that is, how that works, why that works. The various... you know what? Actually, we should probably shut the door there. So I'm on the air, can't hear myself, and can't hear you guys. If you call in, I won't be able to talk to you. At any rate, we're talking about the seminar coming up here. You can go to my website to sign up for it, and there's no cost to attend. However, seating is limited, and again, it's going to be the highest rate of return that you can get on safe investments. And, interest rates are actually moving up. They should move up a little bit more frequently. Hang on 1 second. I think I can... I really have to apologize because essentially we don't have our equipment together. And now I can hear. So, again, my apologies. This is the first time that this has ever kind of gone this way. That's kind of interesting. But if you'd like to call us, 216-901-0945, 216-901-0945. This is probably the slowest takeoff of any show I've done. That's okay. We'll get through it. But yeah, so again, one last time. Highest rate of return that you can expect to get on safe investments. Those things that have guarantees on them. Now, we're also going to be talking a little bit about the value model. I have a little video up on that, up on my website. If you wanted to take a look at that, we've got a value-oriented model that's unique. There isn't another value-oriented model like this one. We've got some other things to talk about on today's show. We're going to be talking a little bit about MLPs. There's a kind of it's not a new product. It's actually been around for a little while, and it's done extremely well. And I'm going to be shifting some of the assets that I manage over in the MLP space to this product that I found out about over the weekend. It's had a much better track record than using an equal weighted MLP or a market cap weighted MLP index, which is kind of unusual. That's actually extremely unusual. So we're going to be looking for that. Not looking for it. We're going to be talking about that at the upcoming workshop. It should be something really interesting. If you're looking at dividends, dividend income, something I think is really important. I think that is going to be very helpful to a lot of people that are on fixed incomes. And the way that those things have played out over the past few years hasn't been very good. I mean, if you look at the 10-year track record, it's awesome because it's 10 years is a long time. It's had a lot of fluctuation. If you look at the last few years, it doesn't look so good. In fact, the last few years, it's got a negative total return, even if you had reinvested your dividends. However, that is not uncommon for stocks, especially value-oriented stocks, especially companies that limited partnerships that really have just not performed well for whatever reason. There are lots of reasons for that. And one of the reasons that I was listening to the portfolio manager talk about is that the structure was so complicated. And yeah, I get that. They're Basically, master limited partnerships comes with these K-1s, these tax returns that show you what you're supposed to report on your income tax return, and they're very confusing to say the least, and the paperwork is enormous. When you put it inside a fund, they tax the fund on the tax-free distribution, so that's one of the reasons that we didn't do that. However, the feeling in the industry is that that's all going away, that they're going to convert, and actually several big MLPs have converted. They converted recently into regular C corporations, so they're still paying the dividend, and dividend's going to be taxed like a normal dividend. And oftentimes there's some tax advantage to that normal dividend, depends on where the dividend comes from. So I think it's going to be a big plus for that entire space. So I think that entire space should actually go back to their past performance days, and they should actually be very good performers going forward. When you make those changes, they're going to be paying taxes. There's a corporate tax that they're not paying today that they'll be paying, but they generate so much cash. And the demand for their product, it's natural gas. The demand for their product is rising. It's rising faster than the inflation rate. It's rising faster than the population growth in the country. That's pretty interesting. So we got a lot of stuff to talk about. A lot of stuff has been changing. And actually, it's accelerated a little bit here over the past few months. Normally, change is pretty slow. These changes have come down pretty quickly, which we're kind of used to. And by the way, while I'm waiting here, and I think I'll just take my headset off. In fact, while I'm waiting here, I've got with me one of my interns, and actually he's going to be a business partner in the website Look Out for the Bull. We're going to be bringing that back. And so I'd like to introduce Mike Seeger. Hey, Mike, welcome to the show.
Hi, Bill. Thanks for having me on.
No problem. And you probably want to speak about an inch away right into the mic. I know you can't hear yourself here, but if you could.
How's that?
That should be good.
Okay.
And here's the, all right. You can actually take a shot with the headset to listen to see. Can you hear it?
Yeah, there we go.
All right. So I'll let you keep it because you're the rookie. So Mike is going to be helping me. We're going to be we're going to be partners, and he'll be doing a lot of the writing, a lot of the editing, and publishing. So we're going to bring back Look Out for the Bull. That's the website where we give out some financial information. We're going to be talking. We're going to start off with the BCAP value model. There's a little video on that. There's an explainer video. I don't know if you saw that on my website, but that's going to be the genesis of Look Out for the Bull. He and I have talked about this in great detail. And so I thought that would be really interesting to bring that back up, have Mike run it. He can add his value to it. It's been very helpful for me because I forget a lot of times what people that are new to the industry don't know yet. And so it's kind of cool to go back and look at those things. Although I'm not sure that you're actually that good of an example because you're a lot smarter than the normal. You're smarter than I was when I started in this business.
I will say it's the first time anyone's ever told me my lack of knowledge is valuable.
Yeah. Oh, man. Yeah. It's extremely valuable. The other thing that's really valuable is the lack of experience. Because you haven't had a lot of bad experiences yet.
Right.
So if you come into our industry and you really don't know what you're doing, there's a really good chance that some of the experience is not going to be so good. And it's not even necessarily that it's not good experience because, stocks go up, they go down all the time. It's if you don't expect that, if you come in with expectations of just making money right away, and then you find out that the average range of the average stock on the New York Stock Exchange back in 1990 was 50% a year. And my question then to you is, do you think the volatility has gone down since then?
Oh, sure.
Yeah. And that's a shocker. So that's a big shock for a lot of newer people. And I think it really helps because an awful lot of people that are thinking more about investing, managing money, we all start out at the same place. It's from the beginning. And there's not a lot of information out there that's actually extremely educational. Most of it's just informational. It's not educational.
Right.
It's not of much use, I say, of much practical use. And so I think you're going to be a big help huge help with being able to see that, and we can get that through a true novice's eyes and kind of get that input and kind of write the articles geared towards people who may not be financial professionals, because that should help us out. Can you hear that? Nope. All right. You can keep
There's
these.
one more. Here.
All right.
Just give us 1 second.
Yeah, this is pretty funny. I apologize for the listeners out there. This is going to sound really good on the podcast. I'm just kidding. But anyway, so I got Mike, and he's going to be looking over the material. He's going to be asking a lot of questions. We're going to write a lot of the articles, cut a lot of video to try to explain those things. And we're going to try really hard to not use language that's particular to the industry. So I'm going to try to keep the industry jargon to a minimum. I'm only going to explain the things that absolutely positively have to be explained and nothing else. We don't want to leave anything out that's important, but we don't want to add anything that's not.
That'll confuse it, right?
Yeah, because I am, I don't know, if you ever saw how I lived, you would laugh. Talk about minimalism. I mean, the places I live in, they look kind of like a hospital. There's nothing there. No there are windows. I have no pictures on the walls. I have all the pictures of my kids that I like. I store them in a chest. There's a chest. I go through that chest every once in a while just to remind myself what the past was like. But and maybe that'll change one day. I don't know. But that's kind of how I like to do things. Everything as simple as humanly possible. I'd like to be as productive as humanly possible with the least amount of effort. Now, having said that, investing involves quite a lot of effort. So I don't want to waste my effort focusing on things that aren't important.
Work smarter, not harder.
That's right. Work as smart as I possibly can. And by the way, I'm a big believer in learning by experience, especially when it's someone else's experience. I think you can learn so much faster from other people that have already experienced what you're looking to experience than you can by going and getting that experience on your own. In fact, at this stage of the game, my life expectancy is not long enough to gain a lot of experience anymore. But anyway, and you had a bunch of questions, I think. In fact, I think we have just a couple minutes here before we have to go on commercial break. But maybe we'll take one of the questions that you had that we're going to cover on Look Out for the Bull website.
Okay. Well, the very first one is kind of simple. What exactly is the model that we're going to be using? I know you called it the BCAP value model.
Mm-hmm. In fact, on the Bullington Capital website, there's a little video there. That's the BCAP value model. It's 51 seconds. Kind of explains a little bit about it. And we're going to publish that on a monthly basis. So there are 50 stocks in that model, by the way. And if you were to start on a particular month, you want to start with the stocks that come up on that month's scan. And it's kind of important that you do that. It's not like life or death important, but it is very important. Okay. So every month, if you were to start, there's going to be a new list of stocks. There'll be 50 stocks that meet a certain criteria that we're going to recommend you invest in. And we're going to have explainer videos. Where do you go? What brokerage firm do I use? How do we rebalance the portfolio? What does rebalance mean? And rebalancing, all that's going to be explained. We'll have various videos in there. It's going to be really educational. And the reason I chose that one is because it's the one that is most commonly heard by people, or not, the model's not most commonly heard. The philosophy is most commonly heard. Buy low, sell high. How many times, have you ever heard that?
Oh, 1,000,000 times.
Okay, so I'm glad that it's still alive out there. The frustrating part is, how low is low? Was Chipotle low when it went from 700 down to 500? No, because it actually ended up going down to 3 something. Okay, is 300 low? Actually, no. If you look at what Chipotle's economic value might be, you look at it and go, wow, that stock should be selling under $200. So why is it at 3 something? Yeah, well, it was at 7 something. And now it's actually started to move back up again, which I think is kind of interesting, because there are enough people out there who don't really look at what the company is actually worth. They just look at the fact that it was down 50% and go, it's time to buy. Well, okay, I'm not in with that crowd. And in the long run, that crowd's probably going to be one of the members of the Dalbar studies that you and I had talked about before today's show. Dalbar studies investor behavior. And over the past 20 years, as access to information has increased exponentially, so has the performance of the individual, except that it's an inverse relationship where their performance has actually gotten worse. They're doing worse now than they were before they had access, before Al Gore invented the internet. So anyway, I thought that was kind of interesting. But so the BCAP value model, again, we're going to take a measure of cash flow, divide that by the cost of buying the entire business, because that converts it into a yield. Well, actually, it converts it into a number that, and you then have to move the decimal place 2 places to the right to convert it to a yield.
Very difficult.
But yeah. So we'll put that. This is all going to be explained, by the way. And the good thing about having Mike there is when I am saying something or we're doing something and it's not clear, he's going to let me know.
Yeah.
So we'll keep trying until we can get it. And I think it's going to be very, very, very beneficial. I think stocks are hilarious. If you have a good sense of humor, they're hilarious. If you're easily offended, not so much. So and I think that's a lot of stuff, a lot of things that people need to know. In fact, when I was brand new in the business, I read this thing, and Warren Buffett said, most people, well, if you know anything about the financial services industry or stocks, the stock market, you've probably heard of Warren Buffett at some point, somewhere along the line. And I read this article, and he was saying that you needed a strong will, because the average stock. Oops, I think I got to go to commercial break. I'll hang on to that thought. You're listening to Bill Bullington and Mike Seeger right here on 1420 The Answer. Stay tuned. We'll be right back.
My feet are frozen on this middle ground. The water's warm here, but the fire's gone out.
And we're back. You're listening to Bill Bullington with my co-host Mike Seeger.
Hi, how's it going?
Good. Mike's going to be an occasional guest here. Try to get him in as much as we can. He's a student at Case and is going to be the co-author. That was interesting. Yeah, he'll be the co-author of the the Look Out for the Bull website that's coming soon to an internet space near you. Thank you, Al Gore. Without you, I'm just kidding. But anyway, so he had some questions for me, and I like to do this. I like to find out what people who don't have a lot of experience are thinking in financial markets. And so with that, I'm going to have you go to your next question.
Yeah. So most of these questions are things that we've actually talked about over the summer as I've been your intern, but we're going to go over them again, just because I tend to forget things. So what about buying a stock and then sitting on it? Aren't we supposed to, isn't it smart to buy and hold on to our stocks for a long period of time?
Yeah. And I'm glad you asked that. And it's a common misnomer. People have said buy and hold from the time that I started into the industry. And there was actually a really good book that was written by Peter Lynch. Peter Lynch managed a mutual fund from 1977 up through 1990. And if you'd have put $10,000 in it, it was worth $330,000 when he retired.
Wow.
$10,000 to $300,000. He's the only person in the mutual fund industry that's ever done that. Okay, he's the one. He's the dude. And so he wrote these books, and they were bestsellers. And in one of the books that he said explicitly that he thought buying and holding was dangerous. Was dangerous. So the guy that's beaten everybody, including Warren Buffett, by the way, his track record was better during his professional career than Warren Buffett's is, or was. A lot of differences there, but anyway, he said that he thought that was dangerous. And here's another thing people didn't know about that fund. The average turnover, when you looked at the portfolio, was 350% a year. Okay, that's the average turnover. Does that seem like buy and hold?
I would say no.
So if the guy that's number one in the entire industry, in the history of the industry, which goes back well over 100 years,
right?
If the guy that's number one says he thinks it's dangerous, I don't know. What do you think?
Might be dangerous.
It's dangerous. Ask anybody that invested in any company that's ever filed for bankruptcy if that was a good thing to do. Yeah. So, and that's what he's saying. It's not necessarily buy and hold. It's buy and manage. That's what he was saying. How often do you look at your stocks? He said probably once every 6 months. Okay. Now, this was a long time ago. Incidentally, is it a coincidence that we rebalance the Bullington Capital Value model every 6 months? Probably not. So that's one of the reasons I do that, incidentally. So we're going to rebalance on a 6-month basis. But you got to buy and manage. You got to have an idea.
So the management is really, you're holding, but you're keeping an eye on it.
Yes. And I think one of the big things you got to get through your head right away is that you're not going to be perfect. Trying to be perfect is typically where the buy and hold mentality comes in. When you buy a stock and it goes down, you don't want to sell it because that would mean you're taking a loss, that you're not perfect. So you're going to wait for that to try to come back, which at that point in time, you're not going to sell it anyway, because if you go through those big losses, why would you?
Right.
There is a tendency, though, by the way, for people who have bought a stock and watched it go down a lot to sell as soon as they get close to getting their money back.
Okay.
That happens fairly frequently, actually, which is typically right before the 50% of the upside appears.
Murphy's Law.
Yeah. So it can be very frustrating. I mean, it's a tough thing to do psychologically.
Right.
Intellectually, it's not hard. I mean, intellectually, it's pretty easy, actually. Yeah, you don't have to be an expert at reading financial statements. It does help if you can. If you're not a complete novice, it can help you. But it's not absolutely necessary. You need to know a few things if you're going to do that. And one of the reasons, by the way, that this stuff is so important, Mike, is that you're going to be investing at some point in time in a 401k, a 403b, or your company's going to have a pension plan. They probably don't. The old style pensions are probably going away. They've been going away for quite a while, unless you work for a government agency. The days of working 30 years collecting a pension for the rest of your life, pretty much behind us. You'll have 401k plans, cash balance retirement plans, where you're actually going to be controlling the money that they put in your account. You're going to be responsible for the management of that if you're not already.
Right.
So I think it's really important that you understand these types of things. They're never going to change. Markets are always going to be volatile. You're going to have to come up with a plan to manage your risk. And that's really the key. Managing your risk is the key. If you do a good job of that, there's a pretty good chance that you can meet your lifelong financial goals, unless your goal is to do 1,000% a year. And oftentimes people will say, well, I'd be happy with 20 or 30% a year. Really? You realize, of course, that one of the richest men on earth, Warren Buffett, hasn't had that average return. He did for a little while, but he wasn't able to keep that up, because at some point in time, it's just not going to be possible. So, and I'm not even sure if that's totally possible today with the tools that we have and the shape that the market's in. It's not in bad shape. It's just that it's a much more level playing field than it was back in the days when those guys were managing money. They had a huge edge over a relatively small percentage of professional money managers. Now the professional money managers outnumber the available stocks that they can invest in. So that's changed. That makes it a little bit different, and also makes it kind of important to kind of understand any of this stuff. Did you have some other questions for me?
Yeah, actually, one of the things you touched on kind of briefly there, you said that investing is sort of easy intellectually, like on paper, but it's difficult emotionally or mentally.
Right.
What exactly do you mean by that?
Okay, I'll give you an example. if you had invested in a company we talked about, I don't know, actually JCPenney, and we've talked about that one. That one's just gotten bashed since I talked about it. Unlike a lot of the other ones I talked about, because we talked about Lionsgate around $5 or $6, ended up going to 40. I think I sold it somewhere in the mid to low 30s, and that's unusual. It's also unusual for a company that's generating a lot of profit to sell below the amount of cash they have on hand, the way that Apple did. And I guess that's what I'm talking about. You're looking at these companies, and they will do things based on the current perception that kind of ignores the underlying financial facts.
Okay.
And that's what makes it really difficult. You look at a company and go, wow, why is that doing that? Why is Netflix selling at such a huge valuation relative to the amount of business that company's doing? It's because people are emotional creatures. There are actually some computer programs that don't look at valuation. They just look at the acceleration in sales and profits, and no price is too high for that computer program. If you didn't know all that stuff, you'd be subject to being whipsawed by it or being hurt by it. And if you didn't know that it was going to be difficult to sit there, watch a stock that has no sales or earnings skyrocket, while the stock that you have, it has no debt and is selling below the cash they have on hand, actually drop in price. If you didn't know that was going to happen, then you'd probably be upset. So I'm here to tell you that it's okay. It's going to happen.
So it's all about managing your temptation to sort of either avoid something that looks really promising but might sort of be a dangerous investment, or holding on to something that's really getting beaten down.
Right. And a really good example, the last 5 years. I don't know if you've heard the phrase FANG. That's Facebook, Apple, Netflix, and Google.
Okay.
Those four stocks make up a huge chunk of the S&P 500. Those four stocks have done exceptionally well.
Mm-hmm.
None of those four stocks is undervalued.
Really?
Actually, 3 out of the 4 are overpriced. 2 out of the 4 are grossly overpriced. And they make up a fairly significant chunk of the S&P 500. So people think that the S&P 500, like all the 500 stocks in that group, have done very well. Well, it's not true. A small percentage of those stocks have done exceptionally well. Most of the stocks have done not so well. Yeah.
That's
so
surprising.
So if you didn't know that, if you weren't able to go in, take a look at the top holdings in the S&P 500 and figure out what they're supposed to be selling for under normal conditions. Okay? And then see that, oh yeah, these guys are selling at prices that are 2-3 times sometimes higher than what would be considered normal. And if you didn't know that, you would invest in that just based on the fact that they just went up a lot. And everybody says, oh, no, I wouldn't do that. Well, why do you keep bringing up the past performance? Because that's exactly what you're doing. So you're not in a large part of investing is being aware of yourself. You know, I think a lot of Buddhists would probably be pretty good investors because they concentrate on awareness. You know, what's going on? We're not just looking at the result. In fact, in most Eastern philosophies, the results, they try to tell you not to form attachment. It's try to remain detached. In Christianity, there's an awful lot of that. It's pay attention to the process. Forget the outcome. It's the process that matters. And you know what? They're right. It's the process. Yeah. So if you pay attention to the process, and that's I guess I don't know if I'm answering your question because
I think so. I think so. It's the practicality more so than the gratification is what you're looking for.
Yeah, and if you do it long enough, well enough, I think you'll be satisfied with what you've done, and you could accomplish some really great things. Fortunately, today, incidentally, it has gotten easier from the standpoint that if you know what you're looking for, it's easier to find those things. There's probably been a computer program written out there that will actually execute that for you. Huh. You just have to find that one.
Okay.
And right now, it's really I think that the bigger opportunities are coming into those that are more value-oriented. I put out a little newsletter. In fact, you know what? I forgot to add you to that list. Sorry about that. Yeah, there's a newsletter I put out every couple weeks. I go through a bunch of articles that are suggested to send out to people. I read the articles and I pick the ones I like. Write a little blurb, and we send that out to all of our clients. So if you're a client and you're not on that list and you want to be on that list, let me know. It's not a problem. We just started the service a little while ago. So I'll, in fact, I hadn't even added Mike yet. So I'll put you on that list. And one of the articles was pointing out that value stocks have not done well. Value, if you Google that, value versus growth stocks, you'll see it that in the long run, value has beaten growth to death. Okay, they're not even remotely close. But if you look over the past 5 years, growth has been the winner. So if reversion to the mean means anything, if there's even 1 ounce of logic that's true in that statement, it's going to revert to the mean. What should you obviously be doing?
I would go value.
Right.
Value, definitely.
You're looking for value. That's exactly what you should be doing. And so, which is going to be good because most of the portfolios they run are already value tilted. Mm-hmm. So the fact that we haven't lagged by a much higher amount, I'm really happy about.
A lot of people are.
Yeah. So we should be closing that gap, and should be at some point in time we'll probably take over the lead again. If past performance can be relied on, and it really can't.
So another question I had, and this is something I've wondered actually for a very long time. Let's say we follow the models that you're talking about. Right. Why don't I just weed out all of the stocks that don't give dividends? Because dividend stocks, they grow, so you make money that way, but you also get paid for owning them.
Yeah. One of the reasons that you tend not to want to do that exclusively is that by the time a company starts to pay a dividend, it's already grown pretty significantly. Apple, Microsoft, Intel, none of those stocks paid dividends during their high growth phases.
Okay.
They were reinvesting all their profits in their businesses. They waited until the opportunities started to slow down, where they weren't going to be able to reinvest at high rates of return, so they're returning the money back to shareholders.
All right, that makes sense.
So the growth rate slows down a little bit, but it is a good way to invest. In fact, there's a fund, and I tested a model that was different than the models that you'll hear about, the dividend achievers, the ones that have raised their dividend, blah, 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 X number of times in a row. If you just lopped off all the companies from the S&P 500 that didn't pay a dividend, you did that for the past 20 years. You came in once a year, lopped off all the companies that didn't pay a dividend, and just kept the ones that did and equally invested in all of them, you'd have done what less than 10% of professionals do. You'd have beaten the S&P.
Wow.
Yeah, I hear the music. That means we have to take a real quick commercial break. We'll be back in just a couple seconds.
I've got things that I thought would fill my heart up, sitting on top, winning, but that ain't winning. Lately I've been reeling, watching the nightly news. Don't seem to find the rhythm, just wanna sing the blues. Feels like a song that never stops. Feels like it's never gonna. Gotta get that fire back in my bones.
Yeah, I really like that song.
It's good.
Yep. In fact, I think I have that on my favorite playlist on my iPhone. But yeah, you don't want to hear me sing it. Anyway, so back here with Mike Seeger, it's Bill Bullington. We're here every Saturday morning from 11 to noon. If you have a phone call, question, or comment, you can still call us today, 216-901-0945, or you can just call us at the office during the week. Or you can go to the website, sign up for the seminar that we have coming up. It's the highest returns you can get on safe investments, quote-unquote safe investments. We're going to be looking at CDs. Interest rates are rising, by the way. There are certain types of bond funds that you want to be holding on to right now. Most bond funds are dropping because when interest rates go up, bond prices tend to drop. We'll talk about why that is. It's also very simple, by the way. And kind of look for areas like we were talking about the value stocks being probably a good place to look.
Right.
They've been had been underperforming. The value model that I'm running, which is really weird, that it coincided with a lot of these articles that are coming out, the articles have been coming out over the past couple months, and over the past 12 months, the value's been catching up. So and that cycle's got a long way to go before it actually rights itself. So anyway, one of the things that you'd asked, you had another question for me, so I thought.
Yeah. This one is a little more specific than the others. I started investing just about a year and a half ago, and my mom, she invests a lot for fun. And one of the things that she kind of turned me on to was Alibaba. It's sort of like this Chinese version of Amazon. And in the past year, I've actually made a pretty good amount of money on it. But the reason that it was, she kind of told me about it is because she saw on some news, something or other, that if you look at the stock prices for when Amazon started out and you look at Alibaba, the two of them line up. It's like a pattern. And I just kind of wanted to know, is that an actual way that you can sort of predict that stocks? No.
that is actually just that's going to be luck. Because what you really should do is you should look at the company, what it's actually selling for, what it's selling, how they make their money. You need to know how much in sales they have, what kind of profit margins they can expect to generate. Those are the two things that drive the value of any company: sales and profit margin. Now, Alibaba's sales were up 73% in the past 12 months.
Pretty good.
Yeah, that's unheard of. Their gross profit margin, 47%. The gross profit margin is before they, it's covering all the costs of basic operations of their business before you start paying interest and depreciation, amortization, all that kind of stuff. So it's basically looking at their operating income. So what are the costs of operating the basic business? Salaries, payroll, health insurance. What are my rents? Take out all the cost of the goods sold. You take out all that stuff. Your gross profit margin 47%. That is really high, by the way. That's a good number. Okay. The net profit margin is 12. What does that tell me? It tells me, yeah, they're an online distributor. They have a lot of expenses. You go from 47% gross profit margin down to 12 net. Yep. Okay. And you're also paying a lot of taxes because they do business all over the world. But that part of it is really good. You look at the market value of the stock. They had $37 billion in revenue. The market value of the stock is $444 billion. Okay. So that's actually it's almost 12 times. So if somebody were to offer me 12 times my firm's revenue over the past 12 months, I wouldn't be on the radio today. I would be so gone so long ago. The average for an S&P stock, a big stock in the United States, is 2.
Wow.
So
that's
yeah,
big difference.
They're at 12. Is that good or bad? Well, it's expensive. That's an expensive company. Is it a good company? Yeah, it's a great company. Very profitable, growing super fast. Probably just not worth what it's selling for. And it's actually kind of the same with Amazon, in my opinion. Amazon's going to have to keep growing. Their revenues were up 40% year over year, so they got that in common. Yeah, both of them are growing by 40%. That's amazing. Amazon's gross profit margin is only 27%. Amazon's net profit margin is under 5%. Yeah. So Amazon only sells at 4.5 times its revenues. So it's selling at a discount that's about 70% or 60%. 60% discount to Alibaba. But both of them are, I should say, optimistically priced as if the revenues will continue to grow that way for quite a while.
Okay.
And which they probably can. I don't know that they're actually peaking yet, but at some point in time, if that were to slow down to say like 20, if you go from 40% revenue growth down to 20, you're still reaching all-time new highs in sales. But because because they're slowing down, you'll see those stocks they'll get pummeled.
Right. The growth is it's still positive, but it's exponentially falling off.
Right, exactly. And when that starts to happen, a lot of younger, newer investors going, well, wait a minute, but their sales, they were up 20%. Why is this stock cut in half? because they were expecting 40. And it all goes to expectations.
Right.
And unfortunately, the thousands of portfolio managers that are out there don't really publish what they think so that you can take a poll. And by the time they did collect that poll, if it were available anyway, it would have all changed. So it's not that useful. And those are the types of stocks that I say, if you really want to own them, do it in a fund. Go find a fund that's investing in them, because the fund's going to buy and sell, kind of like Peter Lynch did. Maybe not to the same extent that he did. You know what's really interesting though about Peter Lynch? His average turnover is 350% a year, and for a large portion of the time that he was managing the fund, he had 40% of the fund in long-term government bonds. Long-term, not in the stock market. Long-term government bonds. People don't know that. So he wasn't buying and selling the government bonds. That wasn't being traded. Those were, when interest rates were as high as they were, you're getting 15% on a government bond with no risk to your principal. Anyway, yeah, you should probably do that.
Yeah, probably.
And so those bonds weren't being traded. They're holding on to them. Mm-hmm. So the 350 was actually probably more like 1,000 on the stocks. Yeah, and nobody knows that. Nobody talks about that. I'm the only person on the planet, I think, that's ever pointed that out. Hey, guess what? But he did say stuff that people thought was like buy and hold. He said some of his largest gains came after 3 or 4 years of holding this stock. That if he couldn't stand to see, now he's a value guy. He wasn't a trader, wasn't a momentum guy. The reason he had so much turnover in the portfolio is those stocks would go up, they would get overpriced, he would sell them. When they would come back down, if they became attractively priced again, he would buy them back.
Yeah.
So that's, the old, and he wasn't even buying low and selling high. Oftentimes his stock was already moving up. He would, I forgot to buy that. He would buy it. Yeah.
So you would say that the whole idea of pattern recognition and the stock market is kind of a fool's game?
No, I think it's very difficult. There is some value to it. Mm-hmm. It's not like people want it. They want to say, you buy it this spot, you sell it that spot. Well, it doesn't work that way. The way that it works is you hold up a chart to a 5-year-old and say, does that look like it's going up or down? If the kid says up, the trend is up. Okay. And everybody thinks I'm kidding when I say stuff like that, but realistically, it's there's some value to it. We can even talk about that for a few minutes at the workshop. I like talking about it anyway. It's actually led to some of my bigger winners in the stock market. Lionsgate was one of those that came up on that. Marvel Entertainment was one that came up on one of those pattern recognition things. But then I looked into why it was moving. I was like, whoa, okay, yeah, I like that. I like that a lot. That's kind of what Peter Lynch did that too, by the way. In fact, he talked about looking at charts. He didn't use them like chartists or technicians do. He just looked at it as like a trend analysis, and hey, there looks like there's a trend there. Wonder why? If there's a good reason, then yeah, that leads to some really big winning stocks. So we'll talk about that too. We only have a few seconds here, Mike. So I want to thank you for coming in today.
Oh yeah, thanks for having me.
Yep, and Mike's going to be the author and or the I don't know how you can co-producer. What's the name for that?
I have no idea.
We'll have to make one up.
I'm the guy in the chair.
Okay. Thanks a lot for listening, everybody. Bill Bullington here every Saturday morning from 11 to noon on 1420. The Answer. Have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.